Hello, I'm Kyle Rodder. In this week's Investor Spotlight, we take a look at the ASX energy sector and drill down into the outlook for it, as well as pick 3 blue chip companies to watch going forward. It's been an almost perfect storm for global energy markets over the past year. Surging demand at a time of very tight supply has seen prices for oil, coal and gas soar, with several factors driving the dynamic. On the demand side, huge amounts of fiscal and monetary stimulus pump-primed the global economy following the pandemic. More importantly, however, was a string of events that caused tremendous energy scarcity. From a structural point of view, underinvestment in old, dirty energy sources as policymakers attempted a transition to new sustainable energy generation has led to a lack of abundant, secure and reliable energy. Meanwhile, the Russian invasion of Ukraine has weaponized trade in oil and natural gas, with the Putin regime cutting exports into Europe, sending prices soaring. The ASX energy sector has outperformed the broader market over the past 12 months. With higher energy prices driving so much of inflation and subsequent interest rate rises behind the general weakness in equities, energy stocks have become a hedge and safe haven in a bearish market backdrop. The Australian economy is very energy rich, so there exists a robust and diverse energy sector for local investors to invest in. In the 1 year to September 16, the ASX energy sector was up over 37.5% versus the broader market, which was down nearly 9%. The upside momentum has admittedly slowed more recently due to moderating energy prices amidst global growth concerns. Nevertheless, it also remains an outperformer across the 3-month and 6-month timeframes. Here we drill deeper into the energy sector and identify 3 ASX-listed stocks to watch. Woodside Energy is Australia's largest oil and gas producer, with a current market capitalisation of around $62 billion. The global energy crisis has seen the company's share price almost double since the beginning of the pandemic. Given its size and scale, Woodside is a relatively safe play for investors in the domestic energy sector. The stock has a beta of 1.25 and trades low relative to its historic price-to-earnings ratio. However, that reflects the short-term run-up in earnings from the energy shock and a discount in price for weaker long-term growth prospects due to the global energy transition. The short-term prospects are considered strong for Woodside, however. The business's current dividend yield is above 13%, and despite some recent downgrades, analysts remain largely optimistic about the stock, with a consensus buy rating amongst 15 surveyed analysts with a price target of $36.65. The charts look less constructive for Woodside stock. Price is carving out an ascending wedge, often a sign of a looming pullback. The RSI is also grinding lower, suggesting building downside momentum. Another blue chip company, Santos, boasts a market capitalisation of roughly $26 billion. Although it has delivered an enviable 1-year return of 26%, that only amounts to half of what Woodside has. It also has a higher beta of 1.92 and a lower dividend yield than its larger counterpart. On the plus side, it does trade at a more attractive multiple. The analyst community is more bullish on the prospects of Santos, however. Of 16 analysts surveyed, all either have a buy or strong buy recommendation, according to data compiled by Reuters. Current prices also trade at a larger discount to the consensus price target, which is around $9.57 currently. The charts paint a mixed picture for Santos shares. The stock is in a primary uptrend, however momentum is neutral with a formidable area of resistance at $9. As we discussed here last week, Whitehaven Coal was one of the ASX's stellar performers in August after delivering solid full-year earnings and providing very upbeat guidance for the new financial year. A shortage of thermal coal amidst huge demand for electricity globally has seen Whitehaven's share price double in the past year. Remarkably, the company trades on a very low beta of 0.6 despite its cyclicality. In large part due to its association with dirty energy, Whitehaven stock trades at a low multiple, with investors pricing in a hefty ESG discount. Analysts remain constructive on the stock nevertheless, with a consensus buy rating amongst 13 analysts for a price target of $8.85. Whitehaven boasts an extraordinary chart, with prices going parabolic recently. The The trend is undoubtedly to the upside, however, risk-reward is likely unattractive at these levels, with the RSI in deeply overbought territory and beginning to move lower.